Yesterday, silver did something almost unbelievable. It surged to a brand new all-time high, pushing into levels many people never expected to see in their lifetime. For a brief moment, silver looked unstoppable. But just like Icarus flying too close to the sun, the rally overheated. Today, silver is getting smashed lower following major breaking news. This sudden reversal shocked traders who were celebrating only hours earlier. The move was anti-random, and it wasn't natural market behavior. Something changed behind the scenes, and that change is exactly what we're about to break down, step by step. The reason for today's sharp pullback is now clear. The Comex has officially raised margin requirements on silver futures contracts. This is big news. Whenever exchanges raise margins during a rally, it usually signals concern about how fast prices are moving. These decisions don't happen by accident, and they don't happen quietly. When margins rise, it becomes more expensive to hold or open positions. That alone can instantly cool off even the strongest rallies. And once again, silver finds itself directly in the crosshairs of exchange intervention. Right now, silver is trading around $62 an ounce. It's bouncing around aggressively, showing just how unstable the market has become. On the day, silver is down about $1.73, or roughly 2.7%. That might not sound extreme in other markets, but for silver, it's a violent move. This level of volatility tells us one thing very clearly. The market is nervous, emotional, and reacting fast to new information. Nothing about today's action feels calm or controlled. Earlier today, silver futures went absolutely wild. Prices surged all the way to $65 an ounce, a level that almost feels unreal for silver. The session high actually reached 65.8 before quickly reversing. On the downside, prices dipped as low as 61.88. That range alone shows how intense today's trading has been. We're now sitting closer to the lows, watching to see whether buyers step back in or if more selling pressure takes control. Here's the key detail everyone needs to understand. As of yesterday, one Comex silver futures contract, representing 5,000 ounces of silver, required $20,000 in initial margin and $20,000 in maintenance margin. Starting today, that requirement jumps to $22,000 for both. That's a 10% increase overnight. For traders using leverage, this is not a small adjustment. It's a direct hit to capital requirements, and it forces immediate decisions across the market. So what does this actually mean in real terms? Anyone holding a silver futures contract now needs more money sitting in their account. If they don't meet the new margin requirement, they risk a margin call. That means depositing additional funds or being forced to reduce or close positions. This affects institutions, businesses, hedge funds, and leveraged retail traders alike. In moments like this, weaker hands are often shaken out, not because they were wrong on direction, but because they can't afford the increased cost of staying in the trade. Margin hikes often trigger a chain reaction. Some traders choose to reduce position size, others exit completely. This creates selling pressure that has nothing to do with fundamentals or long-term demand. It's mechanical, it's force, and it disproportionately impacts leveraged participants. This is why margin changes are such a powerful tool. They don't need to ban trading or change prices directly. By raising costs, they indirectly control behavior. And that's exactly what we're seeing unfold in silver right now. Margin hikes aren't the only tools available. The Comex also has circuit breaker rules designed to slow extreme price moves. These rules allow trading halts if prices move too far, too fast. For silver, a $3 move can trigger a temporary halt. $6 brings a longer pause. $12 could lead to a major stop in trading. These limits didn't always exist. Over time, more controls have been added, especially after periods of extreme volatility. Whether these tools protect markets or suppress them depends entirely on perspective. Earlier today, silver briefly reached something historic. When prices pushed higher, silver climbed into the top 5 global assets by market capitalization. That's something rarely seen. For a moment, silver's total market value was more than double that of Bitcoin. While it didn't last long, the message was loud and clear. Silver was commanding global attention. Even after pulling back, silver remains above massive names like Amazon and Bitcoin, highlighting just how powerful this move has been over the past year. As silver continues to make headlines, bold predictions are starting to appear. Analysts are now openly discussing the possibility of silver reaching $100 an ounce in the months or years ahead. Could it happen? Maybe. But history reminds us that silver is famous for explosive rallies, followed by brutal pullbacks. The same volatility that creates massive upside also carries serious risk. And with exchanges actively stepping in, the path higher may not be smooth or fast. Despite today's decline, silver is still holding above $61 an ounce. That's important. For long-term investors, pullbacks like this are often viewed as opportunities rather than disasters. Many people have been waiting for a dip to either enter the market or continue dollar-cost averaging. Whether this move turns into a deeper correction or just a temporary pause remains to be seen. What's clear is that silver is no longer being ignored. The Comex margin hike is a major event, and it deserves attention. The last time we saw something similar was in 2021, when margins were raised 18% and silver dropped about $2 that day. History doesn't repeat exactly, but it often rhymes. So now, the question is yours. Do you see this as manipulation, risk control, or just part of the system? Share your thoughts in the comments. Thanks for watching, and I'll see you in the next one.